good to have you join us today. Hello and welcome to Business Daily. I'm Lee Ji-yoon in Seoul. We have a lot coming up today, so let's get started with the day's highlights. What can the global economy expect in the new year? Will China's slowing growth trend continue? Will the U.S. Fed continue on its path of raising interest rates? We sit down with an expert to talk about this. More and more people are choosing to shop on the internet, and especially on their mobile devices. With better performance last year, web shopping has actually jumped ahead of brick-and-mortar operations. But first, markets around the world took a battering from the first trading day of 2016 after China's benchmark index nosedived, largely due to the country's weak manufacturing data. The Shanghai Composite Index plunged 7%, the biggest margin in nearly 3 months, before a circuit breaker was enforced to curb market volatility. The turmoil in China sent shockwaves across the U.S. market and extended to Europe as well. The Dow Jones Industrial Average shed 1.6% from the previous close, while the Nasdaq shaved off over 2%, along with the DAX in Germany, which tumbled 4.2%. Meanwhile, oil and gold prices climbed following news of Saudi Arabia severing diplomatic ties with Iran. Brent crude jumped more than 3% at the start of the day, but closed down at roughly $36 a barrel. The price of gold also rose more than 1% to $1,070 an ounce. And with that, let's now take a quick look at how the markets fared here in Seoul today. Korean shares rebounded on this Tuesday as China's stock market rout eased on hopes that authorities might take action to stem severe volatility. At the closing bell, the benchmark Kospi gained 11.77 points to close at 1,930.53, while the tech-heavy Kosdaq rose 6.28 points to finish at 684.07. On the foreign exchange counter, the Korean currency ended at 1,188 won against a greenback. Now, the impact of China's stock market rout will have a quote-unquote limited effect on the Korean economy. That's what Deputy Finance Minister of International Affairs Choi Hee-nam said in a meeting of senior-level officials on Tuesday. He likened the sell-off to a technical issue, adding a flurry of panicked investors overreacted when Shanghai Composite's first circuit breaker was triggered, a mechanism only installed in December. He added the situation was aggravated by heightened risk spawned by tensions in the Middle East between Iran and Saudi Arabia and other allied nations. The deputy minister promised to continue monitoring the markets, even as he assured that local bourses would return to normal soon. But with markets still jittery after China's market rout on Monday, there are growing concerns about the stability of the world's second largest economy. In fact, recent data imply that the road ahead might not be so smooth either. Our Lee Soo-eun has the details.
China sent shockwaves around the world when markets there crashed on Monday, and there are still a number of concerning risk factors of the country going forward. First is sluggish growth. A Bloomberg survey of economists show a median growth projection of 6.5% for China, well below its 7% target. On top of that, China's Manufacturing Purchasing Managers Index, or PMI, has been below the healthy level of 50 for 10 straight months, an implication that external demand for manufactured Chinese goods is on the decline. Next is the possibility of a continued drop in the value of the Chinese yuan. On Monday, markets closed with the yuan at nearly 6.52 against the greenback, the lowest on record since May 2011. Until now, the Chinese government has defended its currency devaluation by injecting foreign reserves into the market. But if foreign investors choose to pull capital out of China triggered by a low yuan, this may no longer be possible. The Chinese market has gradually opened up in recent years with the launch of Shanghai-Hong Kong Stock Connect in 2014 and the yuan's inclusion in the IMF's currency basket last year. With plans to further open its markets this year, including the Shenzhen Index and the MSCI Emerging Markets Index, increased volatility is expected. With corporate reformation on the Chinese government's agenda and the real estate market concerned about a double dip triggered by rising government debt and unstable banks, the Chinese economy has a rocky road ahead. Lee Soo-eun, Business Daily.
From the first rate hike in nearly a decade in the U.S. to the slowing growth in China, the global economy faced many ups and downs last year. So as we start off the new year, we look at what kind of issues and factors lie ahead for financial markets around the world and how they will affect the Korean economy. Take a look.
Global economic growth will be disappointing and uneven in 2016, according to the head of the International Monetary Fund, Christine Lagarde. Why such a grim outlook? With the prospect of rising interest rates in the US and a continued economic slowdown in China, Lagarde expects more uncertainty and a higher risk of economic vulnerability worldwide. On top of those concerns, falling oil and raw material prices are giving headaches to economies dependent on commodities, while global trade is yet to break out of its slowing trend. But some economists remain hopeful that once the world sees an uptick in demand and structural reforms, things will look up for the global economy in the year ahead.
And to tell us more about this, Professor Yang Jun-seok from the Catholic University of Korea joins us in the studio today. So good to see you, Professor.
Happy to be here.
So global institutes such as the United Nations, the World Bank, the IMF, and the OECD are all voicing one similar outlook for the global economy this year, which is the rising share of the emerging markets. Now, they're saying that emerging markets will actually see higher growth compared to other advanced nations, and their share of the global economy and global markets will actually grow as well. Now, what is your assessment of this kind of outlook, and how do you think this kind of change will have an impact on the Korean economy?
Okay, well, the emerging economy share of the global economy was always going to grow. But I think for this particular year, I think the problem is not that the emerging economies are doing very well, but the advanced economies are not doing well. If you take a look at, say, the BRICS countries, Brazil, Russia, and China are all experiencing problems.
Right.
India is the only one which is doing fairly well. ASEAN, Southeast Asian countries are also doing fairly well, but they're not doing great. It's just that most of the advanced economies are doing even worse. So their share in the global economy will definitely rise, but by default, I think. And for Korea, since these emerging economies take 45 to 50% of Korea's exports, they're doing well will mean it will mitigate some of the reduced exports to advanced countries. But still, I think it'll be much better to have the entire global economy grow rather than just a section growing sort of slowly.
Well, a lot of issues last year stemmed from China's slowing growth, obviously, and China has been trying all it can to, I guess, get its economy back on its feet. But then just yesterday, we actually saw trading on China's main stock markets suspended early after its indexes plunged 7%. Can you tell us more about these?
Okay, well, the most credible account of why it fell so much that I've heard so far was that the Premier's Xi mentioned that there will not be an artificial expansionary policy this year, and I think that caught a lot of small investors by surprise, and they started selling the stocks, and once they saw the circuit breaker go into effect, they had further panic on that. But the Chinese economy, the problems with it are known. We know that they have problems dealing from real estate. We know that they have state-owned enterprises, debt problems, and financial sector problems. So these problems are known entities. There hasn't been a surprise since the last few days. So I think in that sense, the markets will readjust. I think there's still some room for the Chinese stock market to go down, but it'll be very important to see how quickly it does. We don't want another shock like we had yesterday, but slowing down, a little fall, I think, is to be expected in the Chinese economy. And obviously, that's going to have some effect on Korean stock markets as well. So.
Okay, can you tell us more about this impact?
Okay, well, because Korean economy is so tied in with Chinese economy, whenever we see a Chinese stock market not doing well, I think Korea will reflect it to some extent. Problem is that we've tied ourselves into the Chinese economic sphere so much that I think, when China was doing well, we got a lot of good out of it.
Right.
But now that China is not doing well, we need to try to develop some other markets. And that's going to be very tough this year because, as we mentioned before, the global markets are not going to be doing that well this year.
All right, well, staying in China, but shifting our focus a little bit. Also coming up this month is the official launch of the Asian Infrastructure Investment Bank, which is led by China. How significant do you think this will be?
Okay, well, I think in the short run, unless China really changes the policies of AIIB, I think it won't help that much in the short run. Because when AIIB was established, China said that at the beginning they'll concentrate more on projects outside China rather than inside China. But as more Chinese firms, construction firms, perhaps with partnership with other Asian firms like Korean firms, start developing the Southeast Asian and Central Asian construction market, it'll probably be very helpful not only to the countries which get the funding from AIIB, but the other regional economies as well. But I think that's going to be in the future rather than right this year at the beginning of AIIB.
All right, and there are also problems arising from the oil supply glut and also the falling raw material prices. Do you think we'll see that continue this year?
For the first part of the year, definitely. I think Saudi Arabia doesn't particularly want the oil prices to rise right now, but there has been more and more indication that the OPEC countries, as well as non-OPEC oil producers, cannot have such low oil prices continue. The IMF has published a report saying that Saudi Arabia cannot last with these low prices for more than 5 years, and other countries are usually doing worse. So they'll probably try to get the prices up, maybe not at the beginning of the year, but at the end of the year or next year. But the problem is, it's not just the OPEC's game anymore. They'll have to seek at least some kind of implicit cooperation with non-OPEC suppliers, and we don't know how they'll react yet, especially countries like Russia, which needs a lot of money very quickly.
All right, let's move on to the U.S. Now, are there a possibility, we're saying that there is a possibility of further rate hike in the U.S. Now, what's the latest on that front? What's your outlook on that?
Okay, well, at the end of last year, the last week of December, people thought that the recovery was very solid. But then we had some statistics published this year that said that perhaps the recovery is not as strong as we thought it was. The manufacturing index was lower than expected, and some people are expecting the GDP growth in the fourth quarter to be a lot less than what they expected. So I think they're going to tread very carefully. A lot of people were expecting 1% growth spaced throughout the year this year. It's probably going to be less, maybe 0.5. But we'll have to see how the recovery picks up in the first and second quarter of this year. As long as there's not a rapid increases in wage and the inflation remains steady, I don't think the Fed is that keen to have interest rate increases this year.
But then also coming up this year in the U.S. is the presidential election. So do you think that could be a game changer for not only for the U.S. economy, but for global economy as well?
Well, I think it'll end up in a stalemate. I think the Republicans who are in control of the Congress and President Obama have such a bad experience with each other that unless the policy is something that is clearly in the interest of both the President's Democratic Party and the Republican Party, unless it's clear interest to both, I don't think they're going to agree on anything. But once you get past November and you have a lame duck Congress, then we may see something get done. But for the first 3 quarters of the year, I'm not expecting that much.
Well, given all these uncertainties, what kind of challenges do you think the Korean economy is about to face this year, and how should Korea prepare, I guess, for what's to come?
Okay, well, Korea is in a very difficult position. Usually we look at exports as an engine of growth, and they want to have exports as an engine of growth this year. But the international situation seems that we really cannot count on exports as being the engine of growth. That means we have to rely on domestic consumption, domestic government expenditure again. But a lot of economists don't really want that, because that would mean more government deficit, more government debt, as government expenditure must increase to provide the engine of growth. But I think for this year, we may not have a choice. If you want the growth to be better than last year, I think there has to be some kind of a domestic engine of growth.
And we definitely need to find some new engines of growth, I guess.
Yes.
All right. Thank you so much for coming in today, Professor.
Thank you for having me.
Korea Korea's current account surplus streak is now into its 45th consecutive month. This means the nation's trade balance has consistently been in the black for nearly 4 years. The Bank of Korea says the country posted a surplus of $9.4 billion in November. That's higher than the surplus posted the previous month, but lower than the over $10 billion surplus recorded in the same month in 2014. November's surplus came as inbound and outbound shipments dropped, and exports were down nearly 12% on year. Imports were over 15% lower due to plunging oil prices. The deficit in the service account, which includes tourism and shipping, also narrowed slightly in November from the previous month. Online shopping outlets have logged double-digit growth in sales every year since 2011, as an increasing number of Koreans turn to screens instead of shelves to buy their goods. And finally, last year, web operations managed to outstrip conventional brick-and-mortar stores in sales. Our Lee Joo-young has more.
Sales at e-commerce websites surpassed that of mega supermarkets for the first time in 2015. According to Statistics Korea, online shopping malls in the first 10 months of last year logged roughly $36 billion in sales compared to the $33 billion at big box stores like E-Mart or Lotte Mart. While sales at non-brick-and-mortar operations grew by 19.4% on year, that of mega stores stopped at a mere 2.2%. Market watchers say the growth was mainly led by the sales expansion of social commerce websites like Ticketmonster, Coupang, and We Make Price or WeMap that targeted thumb shoppers, consumers who finished their shopping chores on their smartphones. Ticketmonster said in the month of November, almost 80% of its sales came through mobile devices. The stellar performance from online outlets was also tied to the MERS outbreak that hit offline retailers hard. During the May to July period, when the outbreak was at its peak, mobile shopping took up roughly 80 to 85% of total sales both on and offline. Experts say online shopping malls have great potential for further expansion, and they add that conventional retailers will need to change up their strategies to survive the fierce battle with online competitors. Lee Joo-young, Business Daily.
And that brings us to the end. Thanks for watching. We'll be back tomorrow at the same time, same place for your Business Daily. Until then, goodbye.